Welcome to This Explainer. Okay, today we're doing something really exciting. We are putting Air Products and Chemicals, ticker symbol APD, through an absolute gauntlet. We'll be using the exact valuation frameworks of history's greatest investors to break down the financial DNA of this massive company. We need to figure out if it's currently a value trap or a hidden gem.
Here's our game plan for today. We're going to run APD through 5 completely different legendary valuation lenses, from Warren Buffett's moat analysis to a classic discounted cash flow model, before we bring it all together for a final blended investment verdict. Let's jump in. All right, round 1. Let's start with a quick snapshot of the business and look at it through the eyes of the Oracle of Omaha himself, Warren Buffett.
So just to set the stage, Air Products is a massive $66.2 billion titan in the industrial gases world. With the stock trading around $297 a share, this is a company that literally touches almost every corner of global manufacturing. We're talking refining, medical fields, you name it. And now they're making a massive bet on the energy transition.
Now, Buffett's first question is always about the moat, right? Does APD actually have a durable economic moat? The short answer, absolutely. It's like a fortress. Together with Linde and Air Liquide, APD controls a whopping 70% of a $120 billion market. That is a textbook oligopoly, giving them an incredibly wide moat and, crucially, serious pricing power.
When we run down the rest of Buffett's qualitative checklist, APD passes with flying colors. You've got honest, focused management. The new CEO, Eduardo Menezes, is actively de-risking the portfolio to focus on the core business. We see consistent earnings, with adjusted EPS for Q2 of FY26 projected to be up 19% to $3.20. Add in a super stable debt-to-equity ratio of just 0.28 and operating margins near 25%, well, Buffett would absolutely love this financial stability.
But, and this is a big but, you know Buffett loves his owner earnings, right? Well, because APD is plowing a massive $4 billion into capital expenditures for FY26, their trailing free cash flow is highly negative, estimated at negative $1.25 billion. They are essentially burning cash right now to build the hydrogen infrastructure of tomorrow. So for Uncle Warren, he's probably sitting on his hands, taking a wait-and-see approach until that free cash flow actually turns positive.
Okay, let's switch gears. Up next, we're applying the growth at a reasonable price lens of the legendary Peter Lynch.
Right off the bat, Lynch would categorize APD as a stalwart, a big, lumbering, established giant. But check this out. Their 3-year average revenue growth is actually negative 1.6%. That's a major red flag for Lynch, meaning we need to put the stock's price tag under a microscope. Here's where the math gets a bit ugly for this strategy. APD is trading at a forward PE of 22.5. If we take management's own target of high single-digit earnings growth, say around 8.5%, we get a PEG ratio of roughly 2.6. Remember, Lynch wants a PEG of 1.0 or less. Paying 22 times earnings for 8% growth, that's a hard sell or avoid in his playbook. Plus, the institutional ownership is already widespread, so that special hidden gem advantage is completely gone. Let's move on to round 3 and bring in the father of value investing himself, Benjamin Graham, with his ultra-strict defensive lens. If we run APD through Graham's defensive checklist, well, it's pretty rough. Sure, it easily passes the sheer size test, and its finances are solid with a 1.4 current ratio, and hey, a 2.4% dividend is nice. But a strict Graham investor simply cannot get past a trailing PE over 31 and a price-to-book ratio over 4. Graham famously wanted to buy $1 for 50 cents, not $3. Oh, and that massive Q2 FY25 gap loss due to recent project cancellations? Yeah, that completely ruins the earnings stability test. To really drive this home, let's calculate Graham's absolute intrinsic value. If we plug in an FY26 consensus EPS of $13.22 and a book value per share of $70.24, the formula spits out exactly $144.54. With the stock currently hovering near $300, yeah, Graham wouldn't just avoid this stock, he'd literally run the other way. There is absolutely zero margin of safety here based on his strict criteria. All right, stepping into modern quantitative finance, let's build out a discounted cash flow, or DCF, model for APD. Since APD's current free cash flow margin is roughly negative 10%, modeling this gets a little tricky. We have to explicitly rely on management's guidance that capital expenditures are going to cool down and cash flows will turn positive in the next 12 to 18 months.
Basically, we're assuming these massive bets on green hydrogen facilities will actually start printing cash. We'll project that out, calculate a 2.5% terminal growth rate, and discount it all back to today using a standard 8% weighted average cost of capital.
Let's take a look at the sensitivity table for this model. Sticking to our baseline of an 8% WACC and a 2.5% terminal growth rate, the math gives us a fair value of around $215 per share. To actually justify today's $297 market price, you'd have to assume a ridiculously optimistic scenario with a very low 7% discount rate and a 3% perpetual growth rate. Honestly, the market is pricing an absolute, flawless execution for every single one of their green hydrogen projects.
Now for part 5. How does APD actually stack up against its peers right now?
This is where things get really interesting. In a vacuum, APD looks super expensive. But when we compare it to its main rival, Linde, APD actually trades at a slight discount. Linde is sitting at a PE of almost 34 and a price to sales of nearly 7. So if you believe this unique industrial gas oligopoly simply deserves these premium multiples across the board, APD is actually the cheaper option of the two giants.
All right, time for the final round. Let's synthesize everything we've learned and get to our final verdict.
What we have here is a classic high-stakes tug-of-war. On one side, you have incredible mega-trend tailwinds in the hydrogen economy, strong pricing power, and an almost impenetrable economic moat. APD is literally building the future of clean energy. But on the other side, immense execution risk on over $15 billion of clean energy projects, burning through cash, and a market that's already pricing the stock as if all these futuristic projects are guaranteed home runs.
And here are the final gauntlet results laid out side by side. Strict value investors like Graham, they are out, total avoid. Growth at a reasonable price folks like Lynch, the sluggish revenue and high PEG ratio scream, sell. Buffett is likely a hold until that free cash flow turns positive, while relative value investors looking at the comparables might actually see a reason to stick around.
Blending all these models together, if you want a true margin of safety, your ideal entry point aligns right with our DCF base case of around $215 a share. At its current price of roughly $297, we rate this a solid hold for existing investors. If you already own it, hey, sit back, collect that nice 2.4% dividend yield, and wait for those clean energy investments to pay off. But if you're looking to deploy fresh capital, the math strongly suggests you should be patient.
So I'll leave you with this. Will Air Products' multi-billion-dollar bet on clean hydrogen become the ultimate economic moat of the 21st century? Or will it go down as a legendary capital trap? That is the ultimate question you have to answer for yourself before buying in. Thanks so much for joining me on this explainer, and as always, keep scrutinizing those numbers.